let me introduce the first speaker. She is a member of the Southeast Asia team within Blackrock's client business group. The team is dedicated to the development of Blackrock's distribution and client relationships management in Southeast Asian countries, excluding Singapore. Before joining Southeast Asia client business team, she was a member of Blackrock Taiwan client business team. She was responsible for maintaining relationships with the intermediaries clients in Taiwan. Let us all welcome Ms. Terena Kuo.
Good afternoon, everyone. Thank you so much for having me today. Yeah, and then I love all your energy. It is my pleasure to speak to you all this afternoon. And then before we start, I really wanted to take a moment to thank everyone who have dialed in today. And also thank you, Morgan, for the introduction. This is really, the most exciting webinar I have been on for a very long time. Before we start, I wanted to take a moment to introduce myself and my company. My name is Terena, and as Morgan mentioned, I am part of Blackrock client business team. I cover Southeast Asia market. I think for Blackrock, as you might know, Blackrock is the largest asset management company in the world. We have our headquarters in New York. So for a big company like us, you might think that we are a century-old company. But actually, we were only founded in 1988 and are quite young. We are 33 years old this year. So what do we do? Blackrock, we provide investment management services to our clients. So our clients around the world include institutional clients like pension funds, like central banks, and also insurance companies. At the same time, we also serve retail clients, retail investors like banks, and then, myself, my mom, and people around me. So Blackrock's purpose is to help more and more people experience financial well-being. And we want to help people build savings that serve them throughout their lives by making investment or investing easier and by making investing more accessible and more affordable. So if we can start, if we can refer to the slide, I think looking back at 2020, I don't think any of us could have anticipated COVID-19 and, the market volatility that it would bring. So moving on, to this slide, as a result of the crisis, we have entered what we called a new investment order. The COVID pandemic has set up, pre-existing and profound shifts in how the economy and society operates. And in Blackrock, we see this shift happening in four dimensions, which are number one, sustainability, number two, inequality, number three, geopolitics, and then lastly, macro policy revolution. So these four shifts, it has defined the new investment order. So for investors, how should we position? So for Blackrock, we look at three themes for this year. I think it's shown on the slide. The first theme is what we're calling the new nominal. And what does the new nominal mean? So what we have learned from the textbook or, from the history is that interest rate represents the cost of borrowing or the cost of capital. Or you can say it's the cost of money. So when interest rates are reduced, the cost of borrowing is lower and more people are able to borrow more money. And as a result, people have more money to spend, which causes the economy to grow. And with growing economy, inflation will increase. So that's one side. On the flip side, if we are seeing a stronger growth and a higher inflation, in other words, when price in goods and services are going too high, what a central bank would do is they will raise interest rates to a higher level. So as interest rates are increased, people tend to save because returns from savings are higher. And with less disposable income being spent, less money people can use, the economy slows and inflation decreases. So what I just discussed, that was what we learned from the textbook. However, what is the new nominal? The new nominal we're saying is we are seeing stronger economic growth, the lower real yields. So the nominal real yields, meaning the nominal yields deducting inflation. And at the same time, even though we're seeing stronger growth in the economy, the central banks are maintaining the interest rate quite low. So this is very different, when from a normal situation. And the second theme that we talk about is globalization rewired. So COVID crisis, it has changed our life in different ways. It has also accelerated a number of political transformations. For example, the U.S. and China trade tensions. So the trade tensions, it was obviously a very tense area, particularly in 2017 and 2018. And the COVID crisis has accelerated that trade tension. Now we find ourselves in what we're calling a bipolar U.S.-China world. So, I think people are thinking whether they should align with the U.S. or whether they should align with China. And this bipolar nature is reshaping global supply chains. So what companies now, the companies, what they think is no longer trying to find a cheapest way to develop a supply chain. Instead, what's happening in the world is, the companies are putting more focus on ensuring they can get a product to the market. And it is more difficult now if you have a product line across the world. Companies they just simply cannot source everything across the world. And so now I think companies are focusing more on the stability and more the resilience of the supply chain. And our third theme is what we're calling turbocharged transformation. And this is where, again, we look at how the crisis is speeding up structural trends that were already exist in the economy. And I think the most clear example is something like sustainability. So coming out of the crisis, we have seen such a demand for sustainable assets and sustainable investing, really as a result of concerns around the pandemic and around the health crisis. So this is quite different than what investors believed before. Like people used to thought that when crisis hit, people will run away from sustainable assets. But what we saw last year in March, it was completely the opposite. I think in addition to sustainability, there are...
Okay, I think we can continue from there. Apologies again. I don't know why, I was talking to myself like my grandpa. Sorry about that. We can, continue with the third theme. I think the third theme is what we call a turbocharged transformation. And this is where, again, when we look at how the crisis is speeding up structural trends that were already exist in the economy. And here, the most clear example is something like sustainability. And coming out of the crisis, we have seen such a demand for sustainable assets and sustainable investing, really as a result of concerns around the pandemic, around the health crisis. And secondly, there are also turbocharged transformation and equality. And then lastly, obviously, we're also seeing a turbocharged transformation led by technology. We see the power or rise of e-commerce at the expense of traditional retail. And then, some call the clicks are replacing the bricks, meaning that e-commerce is disrupting traditional brick and mortar stores. But I think back to the point on technology, giving a lot of the disruption in technology, I don't know how much I can rely on it. We still see a lot of disruptions, in connections. And I wanted to say, I still don't think, it can replace people-to-people connection. And one day if I can travel to Manila, it still cannot replace that connection of face-to-face. So on all 3 themes, the new nominal, globalization rewired, and then also turbocharged transformation. Moving on to the next slide, I think 2020 was no doubt a year that no one saw coming and one that didn't play by a traditional playbook. Therefore, this year, I think from a business cycles perspective, we see that 2021 is also not going to be a traditional year. We believe this year will be a year of a restart. Here, we use the word restart because we think COVID is not a normal business cycle recession. Instead, it is a human crisis. It is a natural disaster that put everything to stop. So this scenario is more similar to a pause and go situation. So what does everybody think, is the key of the restart? Our answer is vaccine. We believe vaccine is the game changer, and it will begin to reveal a light at the end of the COVID tunnel. As a matter of fact, we're seeing the vaccination progress leading to an acceleration of the economic restart. And then with the vaccinations, the US, the UK, they are already restarting. And in fact, when we spoke to some of our colleagues in the US, or, what we're seeing in the US media, they are already referring themselves as living in a post-COVID world, which seems to be hard to imagine for people like me, who is still stuck at home at a half lockdown Singapore and having to wear a mask wherever I go. At the same time, in Europe, there is a delay, but we still expect Europe to vaccinate its vulnerable population by the end of second quarter. So for most developed countries, we believe they could possibly reopen in summer. And closer to home, more recently, the virus data across emerging markets, including Asia, however, has been quite troubling as many regions face second and third or even sixth or seventh wave. So we think the reopening in this part of the world will be slower and likely to happen in the later of 2021. In summary, we believe as vaccines are more widely available and accessible, and as vaccinations can be given to the general population, this will loosen up a pent-up demand that allows a continued rebound in activity. So we're going to be in a world where we are seeing acceleration of growth. People can go out, people can go shop, people can socialize, and people can spend. It gets me so excited even just talking about this already. If we move on to the next slide, since pandemic, we think not only consumers were not able to spend money like they usually do because of the lockdown, they saw a considerable boost to their disposable income. I would say disposable income, they receive it through stimulus checks, social security benefits, or pandemic assistance from the government. As you can see on the chart on the left, so here, the red line, it shows the US household disposable income. And then the yellow line here, it shows the US personal consumer spending. So there are more disposable income, more money in the pocket to spend, and then less spending because of the restrictions. And as a result, the money are currently sitting at excess savings. And we believe this number it matters because this number will exceed further by the end of the year. And together with the economic reopening led by vaccinations, the numbers will matter for the growth dynamic right now. Because all these demands, the pent-up demand that I described, it will drive a powerful restart. and the consumer will make significant contribution in the GDP growth in the current and coming quarters. If we move on to the next slide, which I hope to highlight, the point I mentioned earlier, we are at an uncertain time in markets, and this is not a regular business cycle. This is very, very different from 2008, the financial crisis, which back then it was followed by a lost decade of deleveraging and declining trend growth. So we think what we went through last year is not a recession, but a deliberate, global, coordinated stoppage. So it is widely understood that the powerful restart is coming. However, as you can see on the right-hand side chart, it still keeps surprise the forecast. The growth forecast after the initial growth forecast after the COVID shock is being pegged, even worse than global financial crisis in 2008. And that turned out to be far too negative. And ever since, forecasts have tried to play catch up and then revising up. However, if you look at the left chart, back in 2008, it is a complete opposite story. Forecasts were way too optimistic in the beginning and have been revising down the forecast quarter after quarter. So these charts reflect the different nature of COVID-19 shock. And back to my point earlier, we think the current situation is more like a natural disaster followed by a rapid restart, rather than a traditional business cycle recession followed by a recovery, which you would read in the textbook, what you learn in school. And what does this mean? The powerful restart is here, it is real, but importantly, it will only last a finite period of time. We think US growth will likely peak over the summer, but the juicy or the eye-popping data will be temporary, and we will settle back to normal business. And this eye-popping growth number in the coming months, it will also be irrelevant to the central bank's rate outlook. On the government side, if we can move to the next slide, the policy response to COVID-19 shock is enormous. We think that the economic impact of the COVID crisis will be only about a quarter of the economic impact of the global financial crisis. But the stimulus people are getting, the government is giving, is something like 4 times more. And we think the reason behind this, is the objective of government or the role of policy here is less to stimulate the economy. If you look at last year, there's really no point stimulating activity because, it's being purposely stopped. And I think what the role of the government and the policy is instead to provide a bridge during this period to make sure we are on a smooth road to a post-COVID world, and then make sure that we are not creating a permanent scar and damage while we stop the economy, and making sure there's enough money in people's pocket, on the company's saving accounts, and also making sure there is enough liquidity. So this is a very different environment compared to 2008. On the other hand, in addition to consumer growth, if we can move on to the next slide, we see other reasons for higher inflation. So COVID has rewired global chains. Production costs are going up. Again, what I mentioned earlier, companies are looking for greater resiliency, greater stabilities with less focus on efficiency. And global supply chains are, a lot facing, they're facing constraints during the pandemic, such as component shortage, rising raw material prices, and also longer delivery times. Which brings me to my next slide. Earlier, I mentioned that the new nominal theme, which is our first theme, this new nominal is really a bedrock of our outlook. And we think that the US Central Bank, the Fed, is still in the process of building the credibility in its new framework. And this framework, has set a very high bar for the Fed to change its easy policy stance. Simply put, in the traditional way, when there is high inflation, Fed would react to it by tightening monetary policy, by raising the interest rate. However, it is not the case here because we think the Fed has higher tolerance in inflation. It has higher tolerance, to let the labor market to run red hot. And the main reason for that is that the central banks are very well aware that the healing process needs time and needs to be significant to make up for the impact of the COVID-19 crisis. And at the same time, many central banks have noted how, inflation has been under the target for so many years. And now they're looking to ensure that inflation stays higher. So on balance, it would be less quick to tighten policy to address that. So we always describe it as the Fed is being more patient now. So all in all, it's a very interesting dynamic, but also a very powerful one where, I think unlike a traditional business cycle where inflation is actually a positive, inflation can be hurtful for risk asset. I think in our case, now it's quite positive for risk assets, primarily because we believe that central banks will keep rates on hold for quite some time. If I can jump a couple of slides, I think to slide 23. Thank you. Yeah, so I think, sorry, this is a very busy slide. What does this mean for investor? I think all in all, bottom line is Blackrock, we are staying pro-risk in 2021. And on the back of what I shared earlier, the restart of economy, interest rates staying low. And then so we think there are still opportunities to make money in the stock market. We still think equities, the stocks, it looks more compelling when it's compared against bond. And, also building on the strong growth environment, that's also one of the reasons we're staying pro-risk. And on the bond side, on the credit side, we say underweight on a strategic basis, given the rich valuation. However, tactically, we still like high yield for the income. I think overall in the coming months, risk remain as market is still trying to understand, how they react to the exceptional growth data, the eye-popping data, and we may see bouts of volatility as market tests the Fed's resolve to stay accommodative, to stay behind the curve on inflation. So what we think and what Blackrock has been advocating is stay invested and really to look through any of the turbulence. And then lastly, I think I wanted to highlight is that the impact of COVID globally has been very volatile and in a way uneven. So the recovery will not be uniform. And so it is quite important to track the single country recovery progress. It's quite important to make sure you understand what's happening in those countries. So we see this as an opportunity for active managers like us to help investors navigate in the new investment order.